Thank you, Giacomo, for inviting me. It's a big pleasure to join this event. And of course, let's start. So today, I would like to share with you, with the audience, some thought about how digital nomad can optimize his or her tax position, the taxation across European Union countries. I will not go deep in the domestic law of each European countries, but I will take a more broad approach to give some hint about how to deal with a situation in which a digital nomad can produce income across country and how to deal with this situation. So let's start. When we are talking about digital nomad performing activity internationally, we should always bear in mind to take into consideration two approach to taxation about individual income tax, because we have two perspectives. We have perspective of resident country taxation, and the other side we have the source country taxation. From the perspective of resident country taxation, especially in the European Union, the countries has mostly the approach of the worldwide taxation principle, based on which resident countries would like to tax digital nomad on income produced internally, domestically, or also on the foreign income, so that we can talk about a full ability to tax of digital nomads. On the other side, we have another principle that is less applicable inside European Union, that is the territorial taxation principle, according which a resident country would like to tax only based on the income produced inside its own territory. In this case, we are talking about limited the ability to tax. Sometimes we can have also a resident country that, as a general approach, they apply the worldwide taxation principle, but in some cases, they grant to a taxpayer a special tax regime, like let's imagine the non-domiciled tax regime, in some cases like Cyprus or Malta, in which only exceptionally taxpayer can be taxed only on the income produced domestically, internally, in the territory of resident state. Let's shift the perspective. Now we're talking about the source country taxation perspective. Inside the European Union, most of the time, this taxation in the source country depends on if the activity of a digital nomad are performed inside the territory of a source state, especially when we are talking about employment income, self-employment income, and business income. Basically, source state would like to tax digital nomad based on the activity physically, materially performed in its own territory. So now we understand which is the role of resident country taxation, which is the role of source country taxation. And what is the point in this situation? Is that digital nomads should always bear in mind that when he's performing his or her activity abroad, the resident country would like to tax, especially if it's applying the full ability to tax, would like to tax also the foreign income, and how a resident country can tax this income. So also when the digital nomad does not report this income produced abroad to the resident country, nowadays there is always a way for resident country to understand how much income was produced abroad. And in this case, I would highlight a consideration. Until a decade ago, the situation was different about the exchange of information among the resident country and the source country, because it was a little bit difficult back in the days for a resident country to get information about its own taxpayers, about the income produced abroad, because the exchange of information was mostly based on the double tax agreement among resident country and source country, but the exchange was mostly on request from the resident country or spontaneously from source country. So most of the time, this exchange of information did happen so quickly or effectively, but the situation changed in the recent years, in which the international community has chosen to implement an automatic exchange of information in tax matters, meaning that resident country and source country exchange their information beside the needs of request by the resident country of the source country. And nowadays, the main standards are just three. We have the global exchange of information according to the common reporting standard introduced by the OECD, the Organization for Economic and Cooperation Development, in 2014. This regards mostly financial information. Then we have the other standard is a Foreign Account Tax Compliance Act, the so-called FATCA, that was approved by the Congress of the United States in 2010. Also, this regards mostly financial information. And then coming to the European Union situation, we have the European Union exchange of information according to the Directive on Administrative Cooperation, the so-called DAC. We have for our purpose, we will take in consideration the two versions of DAC. There are also other, but for our purpose, we have the first version. It's the DAC 1 that was approved by the European Union in 2011. That's regard also income information like income from employment, director fees, pensions, life insurance products, ownership and income from immovable property. And then in 2014, the same directive was amended by the European Union to introduce the DAC 2 that is also regarding the financial account information, a little bit taking inspiration from the common reporting standard introduced by the OECD in 2014. In this case, the information exchange in an automatic way also regarded interest, dividends, and other income generated by financial account, gross proceeds from sale and redemption, and account balances. So in this situation, that's to explain that the digital nomad performing his or her activities abroad and producing, for example, employment income, self-employment income, and business income abroad should always understand that those income information will be shared with the resident state. And so the first step for digital nomad to achieve a tax optimization would be first avoid the international double taxation. This international double taxation can be avoided with domestic remedies provided by a resident country, her or he is a resident countries, but sometimes the remedies offered by resident country are not enough. So in this case, the digital nomad should remember that there are also double taxation agreement remedies in the European Union. These double tax agreements are mostly based on the OECD model, and on the Article 23 of the OECD model, we can find a different method to avoid this double taxation. The first method is a credit, upon which a resident country grants a credit to its own resident for tax already paid in the source country. And then we have the other method is the exemption method, based on which a resident country can exempt the income produced by digital nomads in their source country. But in other cases, we can have also a situation in which digital nomad can run the way to also to achieve the no taxation in the source country based on the provision of a double tax agreement. And these mostly of the time happen when, for example, a digital nomad is running his or her activity in the source country without triggering a permanent establishment, meaning without having a fixed place of business in the foreign countries, in the source country. In that case, according to double tax agreement, it's still possible to not be subject to tax in the source country. Or in the other situation, let's imagine a digital nomad that is performing his employment activity in the source country, but is not living in the source country for more than 183 days. And in this case, provided Article 15, paragraph 2 of the OECD model, especially if the digital nomad is not getting paid salary from an employer resident in the source country or from a permanent establishment of these employers in the source country. In this case, it can be exempt from taxation on this employment income in the source country. So now that you understand the first step of a digital nomad should be not be taxed twice or not be subject to a double taxation in the deriving from the application of tax from resident country and source country. The second step, which is that once digital nomad knows that at the end it will be taxed in the resident countries, and the resident country will get information from the source country. So the second step to get an optimization of direct taxation for digital nomad is to choose a tax-friendly resident country, meaning a resident country that can grant to the digital nomads tax incentives, tax breaks, or special tax regimes that we can still find in the European Union. They are perfectly legal, and in this situation we can still look at Italy, or like Portugal with not habitual resident tax regime, or Cyprus or Malta with resident non-domicile regime. In my presentation, I would like to focus my attention on the Italian tax incentives, because those are the ones that I'm dealing with every day, and I think they're particularly interesting for the position of digital nomads. There are two kinds of tax incentives. The first one is the Inpatriate workers tax regime, and the second one, the resident non-domicile tax regime for high net worth individuals. I think they are different. There are different strategies behind those regimes for a digital nomad. So let's look the first. So the first is the Italian tax incentives for Inpatriate workers. Those are tax breaks from conceived for employment income, self-employment income, business income produced in Italy, which are the tax advantage. The first tax advantage for sure is the level of taxation. So a digital nomad transferring his or her residence in Italy can get the tax only on 30% of his or her income produced in Italy, and those are for digital nomad becoming resident mostly in the region of north of Italy. And then we have an even better advantage for digital nomad choosing to become resident in the region of center-south of Italy. In this case, the taxable income would be only 10% of the income produced in Italy, and so that would be an achievement of 90% of exemption of income produced in Italy. So, which are the requirements to go inside this tax regime? We have two categories of Inpatriate workers about the requirements. We have the ordinary Inpatriate workers, and we have also the graduate Inpatriate workers. From the first point of view, for the ordinary Inpatriate workers, the first category, we have these requirements. The first requirement is that the digital nomad have not been resident in Italy for at least 2 years before transferring his or her residence in Italy. And then this digital nomad should commit to be resident in Italy for at least 2 years. And then the third requirement is that digital nomads should work in Italy for the majority of each year, for more than 183 days for each year. And then we go to the graduate Inpatriate workers requirements. In this case, digital nomads should have a university degree. Second requirement is that digital nomads should have been continuously working or studying out of Italy, so in a foreign country, in the last 24 months or more. This requirement of 24 months can be accounted not only necessarily in the immediately before to coming in Italy. That's a requirement. This requirement can be also fulfilled back in the years, as long as in the previous year the digital nomad was resident abroad in a foreign country, so not in Italy. Then the third requirement is that the digital nomad should be citizen of a European Union state or of a not European state, but in the last case, necessary that this not European state should have enforced with Italy a convention against double taxation for income tax purpose, or at least an agreement on the exchange of information in tax matters. And the fourth requirement for the graduate Inpatriate workers is that the digital nomad should work in Italy. We can notice that, different by the ordinary Inpatriate workers, for this specific category of graduate Inpatriate workers, it's not required that the taxpayer should work in Italy for the majority of each year. For that reason, I think the graduate Inpatriate workers is a regime that fit very well for digital nomads, because this digital nomad is not mandatory for digital nomads work the majority of time in Italy. They can also go abroad, work from abroad, and still apply to this tax regime. But we can have also completely different position of a digital nomad. Let's say we have digital nomads that want to work mostly abroad, not in Italy, and he or she has also participation in a foreign company, so he's getting dividends, or also is making gains, or is perceiving also interest. So I think in this case specifically, especially if we are talking about a high net worth individual, a digital nomad that fall inside this category, there is another tax regime, Italian tax regime, that could be very appealing for digital nomad. That is the resident non-domicile tax regime for high net worth individual. Of course, in this case, digital nomads should have a high level of income, and which is the tax advantage in this case. The tax advantage is that digital nomad would would benefit from a flat tax of 100,000 euro for a maximum of 15 years, 100,000 euro for each year as a flat tax. For a maximum of 15 years, that's always revocable because this is an option, and this applies only on foreign income. For that reason, I told you that is most important, and this apply and applicable and appealing when the digital nomad is making the majority of his income abroad. And from this tax regime are excluded only gains from the sale of qualified participation, let's say the company, but only for the first 5 years. So maybe you are asking to yourself, which are the qualified participation? We are the qualified participation according to the Italian tax law are the participation that give to in this case digital nomads the right to vote for more than 20% in the company, or in other way, when there is participation to the capital or patrimony of the company for more than 25%. When we are talking about a listed company, this percentage become 2 and 5% respectively. So which are the requirements to apply to this resident non-domiciled tax regime? The Italian version are: first, the digital nomad should transfer his or her residence in Italy, and that's in common with the other tax regime that we've seen before. And second, these digital nomads should not have been resident in Italy for at least 9 years out of 10 before transfer his or her residence in Italy. And third requirement is mandatory to obtain an approval ruling from the Italian tax authority. This requirement is completely different from the one that we have seen from the Inpatriate workers, because in that case, the taxpayer just applied the tax regime inside the tax return. But in this case, for the resident non-domiciled tax regime, is necessary a approval, specific approval from the tax authority. So as we have seen, there are two main steps to achieve a tax optimization from one point of view. That's the first step, is to avoid double taxation by applying the domestic law or the double tax agreement among countries in the European Union. The second step for the digital nomad to get this tax optimization is to choose a tax-friendly resident country and to apply to these legal tax incentive, tax breaks, tax regime that can lower that direct taxation inside the resident state. So hopefully those information would help you. And yeah, if you need any help, any assistance, I'm available. I would also highlight that there is a 50% of discount for the first consultancy call would be about this topic, especially for people that follow this this event. And yeah, if you have any doubt or any question, please ask me. I will be very happy to answer you. Thank you.
Thank you very much, Antonio, for elaborating on all the taxation structure in Europe and also the example on Italy. Maybe I'll take a couple questions that I see in the Q&A. And then what I invite you to do is probably you could comment on those questions and answer directly the people that you see asking them. So maybe I'll take two questions. One is DAC1 and DAC2 still relevant to the UK after Brexit?
You know, of course, after if you are talking about United Kingdom, United Kingdom is out of European Union, so we let's say that is not anymore relevant, but United Kingdom is still inside the common reporting standard, the exchange of information. So that yeah, you can exclude that United Kingdom cannot exchange information with as a resident country with a source country. So that can still happen based on the common reporting standard.
Yeah, thank you. And then you can elaborate more eventually. I can talk to Patrick. And the other question I see from Benjamin is, could you please precise the region of the south and center that are concerned by the 10% taxation? Is it all the south? Is it islands too?
No, there's not the south. Okay, listen. I will interrupt a little bit my presentation. Is it interrupted my presentation now? So I will get access to other files.
Oh, okay. But otherwise, I mean, probably in the interest of time, what we would do you could comment on those questions and answer directly to the people. And then I think they can reach out to you and connect with you in the platform if they want more information or
no, I can just, okay, no, I was just taking a little bit of information. Okay, I can reply on this question. I would like just to be precise. So yeah, I will tell you which is the region. In the meantime, I took documentation. So the regions are specifically the Abruzzo, Molise, Campania, Puglia, Basilicata, Calabria, Sardinia, and Sicily. Those are the regions of South Italy for which you can apply these 10% taxable income.
Yeah. Great. Thank you very much. Thank you very much, Antonio. I think there are some other questions that are very interesting, but I'll let you comment on those. And okay, we'll close this session and reopen with a spotlight by Francesco on Spain, Portugal, Cyprus, Estonia, and Bulgaria. So thank you, everyone, and let's join the next session.
Thank you for having me. Have a good day.
Cheers.
Bye-bye.
Bye.